Okay, well, it's that time of year when people think about starting a business. Maybe they don't like the direction 2025 took them. They're going into 2026 and they're saying, you know what, maybe I should just start my own business. And so they, start looking at franchises. They think maybe they could be a realtor, or maybe they could do their own contracting business, whatever it is. But they don't really think about all the different steps, the requirements that there are to being able to do that. And on today's podcast, we are going to talk about that. All right. Well, hey, it's Stephen Young with Savvy Tax Strategies and Bookkeeping, and your host of the Savvy or Surrender podcast. I am super excited to be talking to you today about starting a business because, well, I've started a few of them, number one. And number two, I find that as I talk to people that are thinking about starting a business, especially if they've never done it before, a lot of times they have no idea really what is involved and what they need to do. So I just wanted to clarify some things, especially on the tax end, but kind of overall what they need to be looking for or what you need to be looking for if you're thinking about starting your own business. Is it deductible? Is it a write-off? What do those things even matter? And so what I want you to think about first, before we even jump into all the content that I have prepared for this, is should you be a business owner? Now, I've talked to, I don't know, maybe because it's the end of the year, beginning of the year, but I had two clients who, for bookkeeping, that chose to not continue their service this year because they are going back to being an employee. And they were actually doing pretty well in business, but they just decided it wasn't for them. They didn't like the roller coaster, the up and down. It can be hard. In fact, on Facebook, I follow a guy, Ryan Stewman. He's known as the hardcore closer. Maybe you've heard of him. He was just recently, he just posted about something about how, you can make $1 million a year in business and still be broke. And that happens because there's just this roller coaster going up and down with just everything, right? Payroll and building expenses and investing and trying to minimize minimize your taxes and maximize your deductions at the end of the year or whatever it might be. So for some people, business is not for them. And, you really need to think about that first. So like I have a neighbor who owned a restaurant, bought a restaurant after being in the corporate world for like 25 years. And the restaurant had been around for like 15 years. And he bought the business, and within a couple of years, it just wasn't working out, and he had to close the business. I just found out a couple of weeks ago, he closed the business like 2 months ago. And obviously that's hard. That's heartbreaking. You put a lot of money and time and effort and tears into the business for it to not work. So the first thing, before we even get into anything, is think about, are you meant to be a business owner? Now, you may not know until you actually do it, right? You'll hear the stories. I'm telling you that it's going to be hard. I'm telling you that there's going to be days, maybe hours every day that you want to quit. And then there's the benefit of it all too. And so it honestly goes up and down. There are days that I want to quit. There's days that I just want to throw this all away and go be a truck driver somewhere and just not care and, just travel the country driving a truck. And then there are days that there's, I had somebody come into my office last week that hadn't filed his taxes in probably 4 or 5 years. And just me giving him the reassurance that we're going to be able to get this taken care of. He said, I had the best night's sleep I ever had last night after talking to you. So it's things like that. It's opportunities like that that drive me, that make me want to continue in this business. So it goes up and down. You're always going to be flooded with different emotions. It's not just a linear success. And so that's number one. That's number one I wanted to get on. But number two, then now let's talk about what happens when you decide to start a business. And the first thing that you need to decide on is what kind of entity you're going to be. Now, you don't need to change your entity status right away. You can I've talked about this on podcast episodes. My dad was a landscaper for 25 years. He was a sole proprietor the whole time. So you don't have to go and change and become an LLC or become an S Corp or a C Corp or whatever right away. But think about what kind of entity you are. Are you going to business with somebody else, or are you going to do it yourself? Kind of plan that out. There's lots of simple one-page business plans online that you can grab that kind of give you some of those some of that structure that you can really identify what your business is. What are the strengths? What are the weaknesses? What are the opportunities? What are the threats? That SWOT analysis, and decide, is this the right business for you? Then you need to decide, are you going to be in business for yourself, or are you going to do a franchise? What kind of business is it going to be? You might already know. You might already have some great ideas. So as you're thinking through those, what I really wanted to get into here for this episode are kind of the questions that I get as an accountant, as a bookkeeper, as a tax person. I wanted to answer some of those questions. And so when people ask me, hey, I'm investing $50,000 into this franchise, I can deduct it, right? Sometimes the question or the answer is no, you can't deduct it, or at least not all at once. And so let's just dive into some of those areas, okay? So there's two timelines. There's before you start the business, and then there's after you start the business. So for example, right now I have a client who is starting a franchise exercise business, and she is in the pre-starting phase. She's paid for the franchise fee. She's getting the location built out. She's buying the equipment, all of those things. She's advertising. She's even paying salaries. Those are all before she even opens the doors and starts selling. And then after she opens, there's a lot of things that are going to be treated differently. So we're going to go through a couple of case studies. I wanted to give some examples. And one example is if you want to be a realtor. And so, or something similar to that. Maybe it could be a contractor or anything like that, but maybe something that requires some training, but doesn't have inventory, no franchise fees or anything like that. And then the other example I wanted to give, because they're so popular, is a franchise and what happens there. So we got two real world case studies, and they're going to have the same rules apply, of course, but there's going to be some very different outcomes. And we're going to kind of see how those come out. And then we're going to have some burning deduction questions that we'll go through that maybe you've thought of, but you didn't know how it was handled. So now we're going to understand it. So there's 5 core tax rules that I want you to kind of think of. So to set the foundation for the case studies, here are the 5 rules. Number 1 is the expenses that you're going to have for the business need to be ordinary and necessary. Ordinary and necessary for the business. So some outlandish things that I've seen, trips to places. You could argue that some board of director meetings, if you're having board of director meetings in, France, and you're a small business in Boise, Idaho, maybe that's not ordinary and necessary. Could the IRS question that? And so, you want to look at that, right? You could also even look at it with meals. Do you really need to go to Chandler's Steakhouse or Ruth Chris Steakhouse when you could go to a regular restaurant? Not necessarily there, right? If you're making a lot of money and you're doing fine, you can go to Chandler's and write that off. Or Ruth Chris or whatever. Chandler's is a local steakhouse. So, Ruth Chris or Lawry's or whatever. But is it ordinary and necessary? And then that can become deductible only after you're actually carrying on in business. So before that, you have what's called startup costs. Now, startup costs are those costs that are incurred before your operations actually begin. And most often, those costs are actually capitalized. So what does that mean? Capitalized simply means that it becomes basically an asset. It becomes something on your books that you have to depreciate over time. So for example, your franchise fee. If I have a $50,000 franchise fee to buy into whatever business it is, I don't get to simply write off that $50,000 fee right up front. I have to capitalize it. I have to call it an asset, and I have to depreciate it over a period of time. And so that is not just simply an expense, but it's an asset. And so you have assets versus expenses. Tangible and intangible assets get capitalized, and then they're recovered via depreciation or amortization, which is actually what the franchise fee is. It's an amortization, not a depreciation, because it's not an actual physical thing. And then Section 179 is, we have that too, right, with our tangible equipment. And so if we have actual equipment, whether it's a restaurant and you've got all the equipment there, you're buying I have a client who owns a striping business. He had to buy a truck. He had to buy the painter and stuff like that. So that was all Section 179 that we used. So eligible equipment after the business starts, we have to look at the income limits or the limits for the Section 179 because of the one big beautiful bill. Same cost, could be different treatment. Here's another one. Training, marketing, and legal, it depends on when you spend it. If you're training after you've already started, you can expense it. If you're training like a real estate agent is, getting her training done or his training done before he actually is able to start being a realtor, guess what? That actually is going to be expensed over time. That's going to be amortized. It's like an asset. You have to capitalize it. So here's where, it kind of comes down to our intentions. So real quick, if you like this video, I would love it if you would subscribe to our channel here, Savvy or Surrender on YouTube. Leave me a review, leave a comment. I would love that. If you're checking it out on the podcast via Apple Podcasts or Spotify, whatever, leave us a review, especially if it's 5 stars. If it's a little less, hey, give me some feedback. I would love to see it. You can also go to savvyOrSurrender.com and get more information there. Just appreciate all of the people that are downloading these episodes, and the emails that I'm getting at podcast@savvytaxstrategies.com have been really helpful. I greatly appreciate it. So the IRS doesn't tax your intentions. They tax the timeline. And so what I mean by that is, again, are you open for business? Could you take a client, or are you still in that startup phase? So the first one is, let's think about a real estate agent or a realtor. Now, a realtor is one who actually pays the dues with the National Association of Real Estate or National Association of Realtors. So that's when they become a realtor. Otherwise, they're just a real estate agent. But most real estate agents, they become realtors, and because there's some politics and stuff that's beyond the scope of this podcast, maybe I'll have a realtor on and we can talk about it one day. But you become a realtor and you have fees and things that you have to do, right? So now in most states, you have to complete pre-licensing education. You have to complete an exam. You have to complete the licensing. You have to actually take the test. And then maybe you have brokerage onboarding. You've got E&O insurance, maybe comes beforehand, might become once you have transactions, just depends on how the state and how your brokerage handles it. So there's money that's spent before just getting that training, before the first client, commission, or even listing. Those are all pre-business costs, and they have to be capitalized. They're not immediately deductible. So if you spend $2,000 on classes, let's say, and another $1,000 on testing and all that kind of stuff, that $3,000 has to be amortized over a period of time, usually 5 years. It could be as long as 15. It just depends on what it is. So those you don't just get to write a check and then immediately have it deducted. Pre-licensing courses and exam prep, state exam application fees, background checks and fingerprinting, brokerage onboarding fees if you have any of that before active work, and then any kind of pre-launch marketing that you may or may not have. All of that before you can actually even do a sale, before you're licensed, that's all pre-sale or pre-launch, and that's going to be amortized. These costs are what help you to become a realtor, not operate as one. So there's your big difference. If you're becoming a realtor, you get to amortize those over a period of time. If you already are one and you're operating as one, then you get to deduct it faster. You get to just expense it. So costs that become deductible after being in business begins things like going and paying your MLS and Realtor Association dues, continuing education, errors and omissions insurance, ongoing advertising and marketing, legal, accounting, bookkeeping, mileage and vehicle expenses. Things like that are all going to be able to be expensed right away, meaning you paid $1,500 for it, you get to expense $1,500 that year. You don't have to drag it out over a period of years. Now, one area that I want to address, especially with the ladies, I get asked this a lot. The men don't typically ask me this, but the women do. Clothing, hair, makeup, pictures. So clothing, hair, and makeup. Let's talk about those three. Typically, you cannot expense your clothes, your hair, and your makeup. Now, the exception to that might be if you can show that you're doing videos with those clothes and you got your hair and makeup done specifically for those photo shoots or for those reels that you're doing, then you might be able to get away with it. A plumber can expense his clothing because he's buying specific clothes, especially if they're embroidered. Now, if you're buying a shirt with your real estate logo on it or something like that, absolutely you can do that. That's not a problem. But if you're just going to Macy's and you're buying a nice dress that you like, and it's, $200 for this dress or something, you're not going to just simply be able to expense that unless you can show how you used it in your advertising. Then you have a better chance of being able to have the IRS approve that expense. Hair, if you're just simply going to get your hair done, probably not going to happen. But if you're going to go get a blowout done because you're doing an Instagram reel or something like that, then you have a little better chance. Okay, equipment and home office. Your laptop, phone, camera, desk depends on how much that costs. So you can write into your operating agreement, you can work with your accountant to create this, what's called the safe harbor exclusion, where you can exclude or you can deduct an expense up to $2,500 for things like a laptop or phone, camera, desk, whatever. You can up to $2,500, you can go ahead and expense it. Anything more than that, so if you're buying a really nice laptop, most laptops are under $2,500. Pretty much every phone is under $2,500. Maybe a desk or something like that might get over $2,500, but keep it under $2,500, and you can expense that just by using that safe harbor exclusion. Otherwise, they have to become capital assets, and then you have to depreciate it and things like that. Home office, of course, you have the home office deduction that you can do on your taxes. And so typically there's the standard and the itemized. So your standard it's $3 per square foot. So I'm sorry, $5 per square foot up to $3 per square foot up to 1,500 square feet. So no, $1,500. My goodness. $3 a square foot, 500 square feet, $1,500. All right. It's getting late in the day here. I'm doing this one in the evening time rather than in the morning time, and I'm still not awake. And then, or the other way is to itemize it, where you actually calculate everything out. You say that your office is 10% of the house, and so you take 10% of all the expenses, and you figure out which one is better, which one actually works out for you. So you can deduct that home office, even if as long as you're doing transactions in there, and as long as whatever that home office is being used is strictly dedicated to the home office. So if you are taking a spare room in and using that as your office now, and it also has gym equipment in there, or you also have a Murphy bed in there or something like that, and it's used for something else, you're not able to use that whole space. You're only allowed to use the space that you are dedicated for an office for your business. So you want to watch that. There was a case where they claimed the entire office was used for the whole space was used for an office, and they took a picture for the IRS for an audit because they questioned it, and they had some gym equipment in there, and the IRS was able to say, nope, sorry, that's not exclusively used for your business. So you definitely want to check out that and be careful with that. You don't want to abuse it. Okay, so the big realtor takeaway is if you're getting licensed in the cost of admission, running the business is where the deductions get to begin. Case study number 2. Let's say you're a franchise startup, so super capital heavy in the beginning of the business, right? The business owner uses their own income or uses their own savings account to buy into a franchise. Now, this could change a little bit. Well, it's not going to change how you deduct it, but one fantastic way that I love to see is when you can use, not that I'm recommending you use your retirement account to buy a business on the hopes that it's going to work out, but if you have a way to use a ROBS, ROBS, to set up your business and to have that own it, that is a fantastic way to build a lot of wealth tax-free. So look into the ROBS loans and see if that's something that makes sense for you. It is expensive to set up, and not everybody qualifies to be able to do it, but it could be a great way to take advantage of that. Okay, so Things that are before you get started with a franchise. You've got your franchise rights, right? The $25,000, $50,000, whatever it is that they charge you to be able to own a franchise. Training, your build out. Let's say you're going to have a building, a restaurant or something like that, or a gym like my client, where you're building out this whole area and you've got $50,000 to build it out or $100,000 to build it out. All of those costs, the equipment, inventory, all that stuff is handled a little bit differently. So let's talk about it. Now, the big difference between that and a realtor is primarily it's human capital, right? Like, yeah, you got to buy the classes and take the tests or whatever, but it's not a lot of outgoing expenses. A couple $1,000 and you're in business. 40 in Idaho, it's 80 hours of training, 2 weeks, 2 40 hours classes, and a couple of tests. And you now are licensed to be able to help people with their largest financial investment. Whereas, somebody who needs to cut hair has to go through months of training. So yeah, when I had my real estate license, I used to laugh with the person at Sports Clips cutting my hair about how they had more training than I did to be able to sell a house for, $1 million. But anyway, that's beside the point. Doesn't matter. That's called great lobbyists. That's what that's called. Okay. That doesn't matter though. So a franchise, it's more intangible rights and physical assets. So there's a difference between a realtor, primarily human capital, franchise, intangible rights, and physical assets. That's why I chose these two case studies. Are kind of opposites of each other, right? So what must be capitalized? Again, capitalized is when we're creating a thing, we're creating an asset, and then we have to depreciate it over time or amortize it over time. So your initial franchise fee, it's an intangible asset. So you've got to amortize it. You don't get to just write it all off. Pre-opening franchise training, legal and accounting before opening, pre-launch marketing, and your site build out and leasehold improvements. Those all become a capitalized item that you have to depreciate over time. And depending on what it is, depends on how long you have to amortize it. Your assets and equipment. Now, let's imagine you are a gym. Let's stick with that example. And you have all of that gym equipment that you have to buy, your point of sale systems. Maybe you even have a little juice bar or something, and you've got your kitchen and retail equipment and all your furnitures and fixtures. You actually get to use the Section 179 of the tax code to write that off a little faster. You still have to depreciate it, but you do have the opportunity at least to make it a little bit faster, right? So it's not just simply franchise rights. Franchise rights, buying that franchise, that $50,000, whatever it's going to cost you, that is not Section 179 eligible. It has to be something actually tangible that you can use for Section 179, like equipment, like a truck, something like that. Inventory are cost of goods sold. So opening inventory goes to your cost of goods sold. So you can expense that right away because you're going to replenish it very quickly. Some indirect costs will need to be capitalized, and the exception may be that you need to make sure you track everything. And then once it's open, those ongoing deductible costs like rent and utilities, insurance, payroll, royalties for your franchise, you pay a couple points or whatever on the franchise royalties, required advertising fund contributions, ongoing marketing, travel and post-op opening training, all of that you can write off right away. Those become deductions or expenses that you get to use right away. So on the franchise, buying a franchise is buying an asset. Operating it is where the deductions actually start to live. So if you do a side-by-side comparison, it really just depends on, one, how much money you have. If you've got a lot of liquid capital, most franchise owners are a little older because they've been able to build up that capital. A lot of times they use their retirement. I bought a franchise business about 12 years ago, and when I went to the training in Orlando, Florida, there was a guy there that had been a nurse for like 30 years, and he decided to use his 401k to go and buy the franchise system. So he had to pay the $25,000, I think it was, for a new franchise. and he bought a van and the equipment that we had for it. They cleaned fryers in restaurants. So it was called Filter Fry. And so he went and bought all this stuff. He was going to be, I think, in like Alabama or something like that, somewhere in the South. And he paid all this money for all that stuff. And within a month or two, he was out of business and just tried to rescue what he could, sell the van and the equipment or whatever. But that was it. He was out of business very quickly. And I felt so bad because he was older. He was like in his late 50s, I'd say, older meaning within 10 years of retirement. And he had just spent a lot of money of his retirement to do that. So be very careful, be cautious with it. I know sometimes it sounds really good to go and do this. And there are success stories as well, of course. I have a client who did do a Rob's loan with their 401k and they're killing it. Now they also are using profit first. So that's kind of the next area outside of taxes where you can use profit first to set up your business correctly. The client that I have that have a Rob's loan to start their business, they didn't use profit first in the beginning. They came to me and we implemented profit first and their business turned around almost overnight. And they're super happy with the success that they're seeing. Now they drove a lot of that. They're obviously are very good business owners and they know what they're doing and they're selling and they're being successful with it. But a lot of that happens to be because they implemented profit first into their business. And so they're seeing a lot of success there. If you don't know about profit first, the book is right here and you can go to Amazon to get it. The author is Mike Michalowicz and you can just look up Profit First. It's been around for about 12 years now. One of the business plans, bestsellers on Amazon, has been around for quite a while and it's just changed a lot of businesses. So with that, I want to wish you well if you decide to go into business. And if you would like help, if you just want to say, you know what, I'm thinking about doing this and I want to run it by somebody, schedule a free discovery call. Go to meetwithsavvy.com and schedule a discovery call with me. I'd be more than happy to see if there is anything that I can do for you. We are a registered agent in Idaho, at least. So if you're an Idaho business, we can help you get your LLC set up or S Corp or whatever it might be, your EIN, your operating agreement, and help you to understand what it takes to be in business for yourself. Thanks so much. Have a good one.